Investing money into the stock market is a nightmare for a lot of people, because all they hear is the bad news of people losing their capital. But those who know what a stock market is cannot deny the fact that investing is one of the best ways for you to grow your wealth by using your money to build more wealth instead of using your time. But if you are completely alien to the world of investing and you don't know how the stock market works, well, in this video, I will talk about what the stock market is and how exactly it works. So make sure to stick around until the end if you are here to start your investment journey. Let's begin, shall we? Investing is an art, and not everybody knows how to master it, even though everybody can. Most individuals keep most of their money in the bank with very negligible returns as interest, while the rich generally invest the majority of their wealth in stocks and other cash flow generating assets. If you think that stock market investing is something that's extremely scary and is only limited to a select group of people, well, that is not true. Only people with extremely limited financial experience are the ones that are terrified by the horror stories of investors losing a lot of money in the stock market. What they don't understand is the fact that investor sentiments depend on fear and greed, and that's exactly what runs the stock market too. Most people stay away from the stock market because they think there's a lot of risk involved. But the truth is, if you approach the stock market in a very disciplined manner, it can be one of the best ways for you to increase your net worth. But what exactly is a stock market? In order to understand the stock market, you need to know what stocks are. A stock is a financial instrument that represents ownership in a company, and it represents a proportionate claim on its asset and earnings. They are also known as shares and equities. So, you don't have to be confused because they all mean the same. So, what exactly does owning a stock mean? Well, if you own a stock, it means that you're a shareholder who owns a portion of the company equal to the number of shares held as a proportion of the company's total outstanding shares. Let's say that you own about 100,000 shares of a company that has about 1 million shares. That means you have a 10% ownership stake in it. Most companies today have millions and billions of shares. Now you might be thinking, why exactly are companies issuing shares? Why do they want your money? Well, most big businesses that you see today started as small private entities launched by visionary founders a few decades ago. However, if they want to expand their business, they need to have access to a massive amount of capital. There is a limit for these founders to raise capital by themselves to turn their idea of a business into a reality. They also have to deal with a lot of expenses, like hiring employees, buying equipment, raw materials, and creating a distribution network. Depending on the scale and scope of the business, these require massive amounts of capital, so they need more funding than what they could get from ongoing operations or traditional bank loans. That's when companies decide to go public, by selling shares to the public through an initial public offering or IPO. This will change the status of the company from a private firm whose shares are held by a few shareholders to a publicly traded company. An IPO will also offer early investors in the company an opportunity to cash out part of their stake, and they'll be rewarded heavily once the company's shares are listed on the stock exchange. So, when a company is listed in the stock exchange, you and I could be part of these companies as investors. Now let's discuss the stock exchange. Stock exchanges are secondary markets where existing shareholders can transact with potential buyers. It is extremely important for you to understand that the corporations listed on the stock market do not buy or sell their own shares on a regular basis. Companies will only deal with stock buybacks or issue new shares, but they don't deal with day-to-day operations, which often occur outside the framework of an exchange. So, next time when you buy a share of a stock on the stock market, you're not directly buying it from the company, you're just buying it from some other existing shareholder. When you're selling your shares, you don't sell them back to the company, but you're selling it to some other investor who is interested in the same stock that you were once interested in. Now you might be thinking, how exactly are the share prices set? Is there somebody sitting behind the computer dictating the prices of shares of your favorite company? The prices of these shares fluctuate as investors and traders assess and reassess their intrinsic value. There are several metrics that are used to understand the value of a stock, the most popular one being the price-to-earnings ratio. If you want a detailed video on that, do let me know in the comments section below. And if you made it this far, consider subscribing to my channel for more videos just like this one, and turn on post notifications so that you get notified whenever I upload a brand new video. The prices of shares on the stock market can be set in several ways. The most common one is buying through an auction process, where buyers and sellers place bids and offers to sell or buy. A bid is the price at which somebody wishes to buy, and an offer is a price that somebody wishes to sell. So when the bid and ask price coincide, that's when you have a trade. The entire stock market is made up of millions of traders and investors, and they may have different ideas about the value of a specific stock. The same holds true for the price at which they're willing to buy or sell. There are thousands of transactions that occur as these investors and traders convert their intentions to actions by buying or selling the stock, which is the reason why the price of stock keeps on changing by every second. It's the stock exchange that provides a platform for such trading to be easily conducted by matching buyers and sellers of a stock. Keep in mind that the stock market is not the same as a stock exchange. A stock exchange is just a part of the entire stock market. In order to get access to these exchanges, you need a stockbroker. If you are clueless about what stockbrokers are, well, they act as the middle person between the buyer and seller. Getting a stockbroker is commonly done by creating an account with an already established retail broker. Now, what exactly are the benefits for companies that are a part of the stock exchange? Well, for most entrepreneurs, their ultimate goal would be to get their company listed on a reputed stock exchange like the NYSE or NASDAQ, because an exchange listing means ready liquidity for shares held by the company's shareholders. An exchange listing will also help the company to raise additional funds by issuing more shares. Having publicly tradable shares will also make it easier to set up stock option plans that can attract talented employees. Listed companies have greater visibility in the marketplace. The analyst coverage and demand from several institutional investors will also drive up the share price. This is the reason why most large companies are public rather than private, and there are exceptions too. Now, should you be investing in the stock market? Studies show us that over long periods of time, stock market investment generates returns that are far superior than every other asset class out there. Okay, we're not considering the cryptocurrency market here because of its volatility. You make money with the stock market from dividends and capital gains. Now, capital gains is when you sell a stock at a higher price than the price at which you purchased initially, and a dividend is the share of profit that a company distributes to its shareholder. And dividends are an important component of stock returns. So, if you haven't stepped your foot into the stock market, now might be the right time to do it. But make sure that you invest the money that you're willing to lose, and you invest in assets that you clearly understand. You should also be aware of all the risks involved in investing in stock markets, because if you don't do it right without any market research, you will end up losing a lot of money. This video is not financial advice, and this is purely meant to be infotainment content. So, what are you waiting for? Start your investment journey today. Learn about the stock market and consider investing as early as possible, and hopefully you will thank yourself later.